It's moving 10 days a year. So are Bitcoin's best days in the fourth quarter? Probably, because we have catalysts, the Fed's easing. We have a shutdown that's been risk off. We have China-US tensions that, look, every time there's a headline on China, like Bitcoin takes a gut punch, right? Because it is money flows and deleveraging. So that goes away. We have seasonality that favors stocks moving up. Stocks moving helps Bitcoin. So to me, the chances of Bitcoin having a huge fourth quarter are really high. And not all of these would be tailwinds for gold. So I wouldn't count. I still think it's possible for Bitcoin to hit 200,000 by the end of the year.
Everyone thinks they've cracked the Bitcoin code, the 4-year cycle, the predictable halving rallies, the timing of each peak. But Tom Lee says that kind of certainty usually marks the point when the script changes. When too many people expect the same outcome, the market tends to surprise them. So, if everyone's waiting for a peak early next year, Bitcoin either already topped, or this cycle will stretch far longer than anyone expects. Lee warns that volatility is part of the deal. Even in a strong uptrend, 50% drawdowns can happen fast. The S&P 500, for example, has endured multiple 20 to 25% corrections in just the past 6 years. If equities stumble again next year, Bitcoin could easily drop twice as much before resuming its rise. Still, he sees plenty of upside. Most of Bitcoin's yearly gains come from just 10 or so big trading days, and those bursts often arrive when the Fed pivots toward easier policy. With rate cuts likely ahead and risk appetite improving, the fourth quarter could bring one of those bursts. Under the right conditions, he says, Bitcoin could still make a run toward $200,000 by year-end. As for gold, Lee admits it's quietly outperformed almost everything this year. The July breakout formed a textbook cup and handle pattern, confirming strong technical momentum. But he believes it's more than just a chart story, it's a reflection of deeper cracks in the financial system that investors are only beginning to notice. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Most of the crypto people I speak to expect a 4-year cycle. Mm-hmm. And they're adamant, that maybe Bitcoin peaks early next year. But as you know, when something is so strongly held, it's very unlikely to be true. So either Bitcoin's already peaked or we have a longer cycle. I'm more in the camp that it's a longer cycle. I'm sure there'll be 50% drawdowns because the stock market has more frequent 25% drawdowns. I mean, that's when, even though people realize, the stock market's made a lot of progress last 6 years, we've had an unusually large number of 25% drawdowns. Mm-hmm. And we probably have another S&P decline of 20% next year. So if the S&P is down 20, Bitcoin could be down 40. It's moving 10 days a year. So are Bitcoin's best days in the fourth quarter? Probably, because we have catalysts, the Fed's easing. We have a shutdown that's been risk off. We have China-US tensions that, look, every time there's a headline on China, like Bitcoin takes a gut punch, right? Because it is money flows and deleveraging. So that goes away. We have seasonality that favors stocks moving up. Stocks moving helps Bitcoin. So to me, the chances of Bitcoin having a huge fourth quarter are really high. And not all of these would be tailwinds for gold. So I wouldn't count. I still think it's possible for Bitcoin to hit 200,000 by the end of the year. There's a lot of reasons gold probably is going up. And at Fundstrat, we don't do commodities. I kind of regret not recommending gold because it's been so great. Because, generally, I like to be helping our clients be involved with things that are going up. So I think gold's move is
it's a good strategy.
Yeah, exactly. I don't want to fight it. And
what kind of business do you have? I help our clients' portfolios go up.
Yeah. So gold's been amazing. I think what's really stood out is that you can explain gold's move by just pure technicals. Like I was talking to our technician, Mark Newton, yesterday, and he says that gold had a cup and handle pattern that the breakout was July of this year. And so the measured move should have taken it up to where it is now. But let's say price leads fundamentals. I think that July is also the time that the stablecoin industry started printing a lot more creations. And as you know, there's been gold stablecoins and dollar-based stablecoins, but a lot of the dollar-based stablecoin issuers are over-collateralized. So I think the stablecoin industry has been printing a lot of dollars, they're over-collateralized, and I think they've been buying a lot of gold.
Interesting.
So I think that the stablecoin industry has been the newest bid for gold.
More so than even like a China central bank?
Yeah, because they've already been present. The central banks have been present for some time, but there's somebody new buying gold on top of the retail buying gold. And I think that would be my guess. Because, like I've now there's like 7 or 8 gold stable coins. Yep. Plus, there's big stablecoin issuers. And so that could be the bid to gold. Now, does that mean gold is unlimited on the upside? I don't know. I mean, I'm not studying it, so I don't know. But I think it's very bullish for Bitcoin and Ethereum because...
Why?
Well, gold moves first and then Bitcoin catches up. So I think that there is going to be the network value of gold just went up by a lot. And so let's say gold settles at 5,000. That puts fair value of Bitcoin, like 1.6 to 2 million if it matches gold's network value. So I think it's actually helping Bitcoin's future terminal price.
Tom Lee argues that calling this market a bubble misses the point. If you look at valuations through a risk-reward lens, he says we're nowhere near the kind of excess seen in past manias. In 1998, the Fed was pausing rate hikes and preparing to cut, just like now, and Cisco, the leading tech stock of that era, was trading at 56 times forward earnings. 18 months later, it peaked at over 200 times. And that was a company selling routers in a highly competitive market. Now compare that to NVIDIA. It's the undisputed leader in AI chips, the backbone of every major model being trained, yet trades at just 27 times forward earnings. For context, Costco trades around 50 times and Walmart around 34. So, NVIDIA, arguably the most strategically important company in the world, is cheaper than a retail chain that sells groceries. That's not a bubble, Lee says, that's opportunity. When critics argue that the entire market is overvalued, Lee pushes back. Stocks are pricing in a coming surge in productivity. AI isn't just replacing workers, it's creating new systems of intelligence that can supercharge output across industries. Markets are simply front-running that shift, not losing touch with reality. Let's get back to the interview.
I mean, if we're measuring bubbles based on like risk reward, we're pretty far from it because in 1998, September, which is similar to today because the Fed was on pause and then they started cutting again September 98, Cisco, which was the biggest company at the time, was trading at 56 times forward PE. 18 months later, it got to 210 times. Now, Cisco made a commodity router that had many competitors. NVIDIA today is the singular most scarce company in AI. They make a chip that everyone who is building a premier model needs. It's trading at 27 times forward earnings. Costco trades at 50 times forward earnings and Walmart's 34 times. So NVIDIA is still cheaper than a membership club company. So I'd say that's why we're pretty far from a bubble.
And when you bring that up to people who are skeptical or critical of kind of the AI companies, what is their response to that?
I think people then say, well, there's a generalized stocks are expensive problem. And because I was just in Latin America and that's what a lot of the pension clients said. But to me, the problem people have is that stocks are trying to discount the future. And AI is not only a labor replacement, so we can calculate, job replacement, and that's a use case. But then there's this agentic and super intelligence potential, which creates productivity. So how do we discount that in the stock prices today? I actually think stocks are still cheap. And I know Jensen was in New York recently, met with some analysts, and I think a lot of the takeaways people had is that in the AI world, companies, enterprises that are spending are starting to see payoff on the AI spend, which means spending is picking up. I actually think AI spending is actually accelerating. One of the best measures of large investor sentiment is the AAII Net Bulls Index, bulls less bears, because it's been run for 40 years. This year, it's averaged minus 11.7. So every week, the weeks through this year. There's only 3 other times in the last 40 years it's registered negative 11.7. 1990 or more, 1990, 2008, and 2022. All were bear market years. So sentiment reads as if we're in a bear market and the market's up 15% year to date. Why is it the most hated? I think we show this in our research that it's based on political divide. So the country is 50-50 Republican Democratic. But in the stock market world, and there's Pew Research data on this, 57% of professional money managers are Democratic. 66% of hedge funds are Democratic, and something like 69% of venture capital funds are Democratic.
Interesting.
So the risk capital world didn't vote for Trump. So they view his policies as that of someone who is destabilizing to the economy. In the bond market, it flips. 80% of credit managers are Republican. So that's why this year the bond market hasn't been, high yield spreads have been stable, credit spreads have been stable, but the stock market's been volatile. How many economists have said, oh, tariffs are going to cause a recession, or tariffs are going to cause an inflation surge? That is actually a very subjective argument, because tariffs are a tax. And if we treat it as a tax, taxes are not inflationary. So we never say it's inflationary. But the economists who are portraying it as inflation are, I think they're taking a specific view that makes it an inflation argument. So in other words, there's some sort of bias in that statement. I don't really have an idea what the following year looks like until early December, because then we're only 1 month left in the prior market. Because this year, for instance, I think S&P gets to 7,000, right? But if we get to 9,000, then it pulls from next year. So, so price being a little unknown, I think there's a lot to be optimistic about in 2026, because one, monetary policy is easing, and that's room for mortgage rates to come down. And we know there's a huge pent up market for not only housing to become more affordable, like through allowing capital to build cheaper homes and stuff, but for people to have relief from mortgages. The ISM, which is the benchmark of manufacturing confidence, has been below 50 for 32 months, the longest stretch in history. But once the Fed starts cutting, companies can get more confident. So the ISMs recover. That's great for the US economy. We know there's onshoring next year. That's GDP activity. And then AI, I think, is becoming, as you just pointed out, like robots, agentic, superintelligence. These are huge innovations coming next year that are good for earnings growth. So I think the earnings picture looks good. But how much is reflected in the stock price, we don't know yet. Like if we exit this year at 7,000, then there's plenty of room for stocks to do well next year. If we end the year at 8,000, then we're going to have a 30% drawdown. People are willfully overlooking that valuations are actually, they're dynamic. You know, from 1940 to 1967, the 10-year went from 2% to 6%. And everyone should say PE should have fallen in that 27-year period. The PE went from 8 times to 27 times. So in other words, as nominal rates rose, earnings accelerated, and so the PE went up. And that was in a time when 70% of the earnings generated were cyclical. Today, most of the earnings is recurring revenue in the S&P, which is higher multiple. And in fact, the 10-year bond is at 4%. It's at 25 PE. I mean, the bond market's expensive. So, so I think you're correct. I mean, plus in the last 5 years, we had 6 black swans. We had COVID, we had the supply chain bullwhip effect, we had an inflation bubble, the Fed's fastest hikes in history, we had the tariff terrors, and US bombing Iraq's nuclear facilities. 6 black swan events, and the market grew earnings during that time. I would argue PE should be higher because we just battle tested the stock market.
Predictability is the illusion that markets love to punish. Everyone thinks they've decoded Bitcoin's rhythm, the halving cycle, the rallies, the timing of the peaks, but that very confidence may be its undoing. Tom Lee's point cuts deeper than it first appears. Once the crowd starts to agree on what comes next, the game changes. Bitcoin's next move might not follow the well-worn script at all. Whether that means a delayed cycle or an early top, the message is the same: complacency costs. At the same time, the broader market narrative isn't as inflated as skeptics claim. Nvidia, the company fueling the AI revolution, trades cheaper than Walmart on a forward earnings basis. That's not irrational exuberance. It's a sign investors still don't grasp how transformative this technology might be. Lee's argument reframes what many call a bubble. Instead of blind speculation, it could be the early stages of a structural revaluation driven by real productivity gains. When technology reshapes every layer of the economy, asset prices don't just inflate, they adjust to a new baseline of capability. Still, both Bitcoin and equities share one thing in common: they're tethered to liquidity. Every major bull run in history began when central banks eased policy and money started flowing again. With rate cuts on the horizon, the setup looks eerily similar. The question isn't whether volatility returns, it will, but what happens after it clears. Will Bitcoin once again front-run a global liquidity wave, Or has the market matured enough to chart a new, less predictable path forward? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.